This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
At the end of the previous session, we explained that when we came to this chapter 14 and dealt with the reliefs available to individuals in relation to CGT, there were basically three different types. There's the first that we're going to meet, which we see in entrepreneurs relief, that is a bit of a misnomer in terms of it being a relief. You think a relief would reduce a gain or reduce the tax charge on a gain, but no. Entrepreneurs relief, what it does is it's simply a lower tax rate. It is a tax rate, as we're aware of from what we have seen so far in our studies, of 10%. Now that compares favourably with 18 or 28%, the normal CGT rates, and for most taxpayers who may be eligible for entrepreneurs relief in relation to a specifically qualifying disposal, it would basically mean 10% rather than 28%, because this person is almost certain to be a higher rate taxpayer. So entrepreneurs relief, the first one we'll see, is the ability to apply a 10% CGT rate on certain gains. Now, looking at the name there, an entrepreneur. What does an entrepreneur do? He or she runs their own business. Therefore, when they sell that business, that is when this tax relief, this lower tax rate, would be available. But in the true meaning of the word relief, there are then two different types. Some reliefs, there's I'm afraid only very few of them. We'll see one of them specifically in terms of our particular syllabus, would actually exempt a proportion, if not the entirety, of a gain from chargeability to tax. Now that's as good as it gets, actually exempting a gain. But the majority of the reliefs that exist in reality, and also then in terms of your syllabus, are reliefs that simply defer gains, where HMRC recognise that a gain has arisen, a chargeable disposal of a chargeable asset by a chargeable person has taken place. A gain has most certainly arisen, but for whatever qualifying reason, as we will see, it would be reasonable to allow the taxpayer to defer that gain till a future point in time. Now, why that is and what that future point in time might be, we'll see later in this chapter. So three different types of relief. Entrepreneurs relief is the lower, the reduced tax rate of 10% rather than the higher 18 or more likely 28%. We will then have, again through the chapter, a relief that is an exemption. That is going to be principal private residence relief, which basically means when somebody disposes of their home, the property in which they have lived, that should be relieved from taxation. I won't go as far as to say that it is exempt, but if you had PPR relief, for the majority of taxpayers, the PPR relief will cover 100% of the gain arising in relation to your principal private residence, your PPR, as you'll know it from now on. So it's effectively the same as an exemption. But your principal private residence is not an exempt asset, but the gain arising on it should be covered by PPR relief, and normally PPR relief will cover 100% of that gain. In terms of deferral reliefs, we have two such reliefs to deal with within our syllabus within this chapter, and they are something which glories in the name of rollover relief. Again, it is to do with a business circumstance. We discover that, like with entrepreneurs relief, dealing with the disposal of a qualifying business asset, most of the other reliefs, not PPR, which I've just mentioned, but most of the other reliefs deal again with qualifying business assets. And the idea about rollover relief, as we will see, is that a business that uses a trading asset disposes of a qualifying business asset and reinvests the sales proceeds in another. Now, if you've disposed of a qualifying business asset, there may be a significant gain arising thereon, for example, a property used within the trade. But if what you're trying to do is expand the business, so you're selling one property and reinvesting all the proceeds buying a bigger property, then it would be viewed, I think, wisely that it would not be a very clever thing of HMRC to do, to at a time that the business is trying to expand, then take money out of that business in the form of an additional tax charge. Better, therefore, to allow a deferral of the gain, not an exemption, a deferral, till a future point in time, allowing, of course, the business to more easily expand. Let's not try and hit them with an immediate tax charge that might indeed put them off that business expansion. That's not going to be a good idea for the economy. So a sensible one, rollover relief. We roll over the gain made on the disposal of one qualifying business asset, and we deduct that from the base cost of the newly acquired asset. In reducing its base cost, that means that in the future that asset will have a bigger gain, and at that point the gain will crystallise, unless of course you do it all over again. Sell and buy, sell and buy. As long as you keep reinvesting the sales proceeds in other qualifying business assets, HMRC will reasonably, and I think sensibly, allow the gain to continue to be deferred. The last of the reliefs in terms of our discussion now, something called gift relief. Remember we said that a chargeable disposal included not just the sale of an asset, but also the gift of an asset. There were other circumstances as well, loss and destruction you may recall there. But the gift of the asset is the other most likely scenario for you to see in an exam question, other than simply an outright sale. Now, just because you give an asset away, sadly does not qualify you for gift relief. Gift relief will allow a deferral of that gain. How it defers the gain, well, we'll hold off and see that in this chapter later. But once again, for this relief to be available, the asset in question has to be a qualifying business asset. There are other circumstances in real life where gift relief would be available, but for our syllabus, the asset in question has to be a qualifying business asset. So most of the reliefs that we see, entrepreneurs relief, rollover relief, gift relief, are only available in relation to assets that have been used within a business. Business assets, qualifying business assets there. And we will see indeed what they are and how we deal with those reliefs as we go through this chapter. Alright, to begin with though, let's look at the detail of entrepreneurs relief. We know that if this is available, it means that the tax charge to be levied on the gain qualifying for this relief will be only 10%, rather than the higher 18% or much more likely 28%. Right, the relief is available for individuals disposing of a business or part of a business. Now, an individual disposing of a business, to begin with, we'd be thinking in terms of probably the disposal by an unincorporated trader of their assets used within their business, maybe a partner of their partnership interest, or as we'll see, when it comes to running a business as a company, it might be that the individual disposes of their shares in what is an unquoted trading company. But again, we'll see the qualifying circumstances in a moment. There is a lifetime cap placed upon the level of gains eligible for entrepreneurs relief, but it's hardly likely to be a problem for most. The relief covers the first £10 million of qualifying gains that an individual makes during their lifetime. This is a lifetime allowance, so it doesn't relate to each disposal, it's a cumulative lifetime allowance. But again, most of us can only dream of making gains on the disposal of the business anywhere near £10 million. So the probability is that all of the gain that you compute in an exam question, as long as the asset qualifies, will be eligible for the relief. But there's a £10 million lifetime limit. If we are eligible for this relief, then as we said, we will get the CGT rate of 10% regardless of your taxable income. Doesn't matter whether you're basic or higher rate taxpayer, it's a 10% tax charge. Now here's the stuff that you need to learn. This is the important stuff to be learnt. The circumstances in which entrepreneurs relief is available, so far as an individual is concerned, on any qualifying disposal. First of all, the assets in question must have been owned for at least 1 year prior to the date of disposal. There is this 1 year, 12-month period of ownership that is required before the relief will be available to you. Now we're basically talking about an individual disposing of his or her interest in a business. So what types of business do we have? We have unincorporated businesses, a sole trader, or partnerships there. and we'd be dealing with a partner within a partnership. We have incorporated business, whereby the individual does not own the assets of the trade. The individual owns the shares in the company then owns the assets and the trade. So when is entrepreneurs relief available? Firstly, a disposal of the whole or part of a business run as an unincorporated business, i.e., as we said, sole traders or partnerships we're dealing with there. Now, we note, again, look carefully at those words. A dispose of the whole or part of a business. We must be disposing of a business or a recognisable part of the business, not simply disposing of an asset that we use within the business. So here it says the relief is not therefore available if a trader simply disposes of an asset that is used within the trade. It must be the trade itself, or if the trade, the business run by the individual is made up of maybe 2 or more trades, then you must be disposing of a trade, a recognisable part of the business. Simply selling an asset you use in that trade is not good enough and will not rank for entrepreneurs relief. The assets must be used for the purpose of the business. So again, you don't get this relief in relation to the disposal of investments held within your business, your sole trader business or your partnership there. Now, individual business assets of the individuals or partnerships, given what I've just said a moment ago, individual business assets of the sole trader or the partnership will in fact attract entrepreneurs relief if that business has now ceased. Note, the disposal of assets must take place within 3 years of the cessation of trade. It is possible indeed that an individual has run their business for many years, maybe the majority of their working life. But possibly now that business has ceased to trade, given that maybe it's simply come to the end of its life. It can't therefore be sold as a going concern. There's no goodwill value. You can't sell the business as a going concern. But it still has some valuable business assets. It has properties used within the trade. And those properties, if sold as a part of a business sale, any gains on them would have attracted the available entrepreneurs relief. Well, it would be harsh now in a circumstance where the business simply ceases to trade because it can't be sold to begin with as a going concern to disallow entrepreneurs relief. So if the business has actually ceased trading, then within the next 3 years, if you sell off any of the business assets that were used in that business and they generate gains, then up to 10 million at least, entrepreneurs relief will indeed be available to you. But while the business continues to trade, simply selling off an individual asset, no, there will be no entrepreneurs relief. Having referred there in detail to the disposal of an unincorporated trade, often what we see in exam questions is that the individual concerned is not the owner of their sole trader business or a partner in a partnership, but what they are is a shareholder within an unquoted trading company. More often than not, their company, the one that they control. They own more than 50% of the shares. Though, as we'll see, that level of shareholding is not necessarily required for the entrepreneurs relief to be available. So the main one to watch for, the disposal of shares in a trading company. Yeah, the company in question must be a trading company. But it will only now be available, will entrepreneurs relief, where the individual has at least a 5% shareholding in the company. You must own a minimum 5% of the shares in the company there. And you, the individual, must also be an employee and have been an employee, either part-time or full-time there, must have been an employee of the company, again, for a 12-month period of time. When you were looking at individual assets of the unincorporated trade being sold, they had to have been owned for 1 year, 12 months. So it is now, if you're a shareholder, you must have owned at least that 5% shareholding, again, for at least 1 year prior to disposal. If you have some investment assets held within that company, there will be no restriction on any proportionate basis as regards the availability of entrepreneurs' relief should the company own investments. Instead, what is applied, it's not a test indeed that is within your syllabus, but the company will be treated either as a trading company and therefore entrepreneurs' relief will be available, or it will be treated as an investment company and therefore no entrepreneurs' relief is available. It's as simple, either it is or it isn't. There is no apportionment here of the gain eligible for relief. When it comes to looking at certain other reliefs, we will indeed make a proportionate judgment and only give those reliefs in relation to the business asset proportion of what is being sold. But here with entrepreneurs' relief, either the business is classified as a trading company, in which case the relief is available, so long as you own at least 5% of the shares, you've done that for at least 12 months, and you've also been an employee there for at least the last 12 months as well. Okay, those are the circumstances that you must learn as regards where entrepreneurs' relief is available. Disposal by the sole trader of the business, disposal by partners of their partnership interest in that business, disposal by an individual shareholder in a trading company there, but only where you own at least 5% of the shares, only where you've held them for at least 5%, and you have also been an employee. In those circumstances, then again, entrepreneurs' relief is available against the gain or on the gain in relation to the disposal of your shares. This relief does have to be claimed. You would routinely do it, of course, on your income tax computation, along with the income tax computation submitted, but there is a time limit for the claim, and the relief must be claimed within 12 months of the 31st of January following the end of the tax year. When it comes to your CGT liability, remember, you pay your CGT within or by the 31st of January following the end of the tax year. And routinely, you'd expect, therefore, any such claims to have been made by that date. But should that have been overlooked, you've got up to a further 12 months from that date in which to make the claim. So for 15-16 tax year, the following 31st of January would be 31st of January 17. It is by that date you must submit your tax return and pay your tax, both income and CGT. And you then got up to 1 more year till the 31st of January 18 to be able then to make that claim. Right, example 1 now. Calculate Daisy's capital gains tax. Do read a question again, I suppose that's a given, read an exam question very carefully. But when it comes to capital gains tax here, do read it carefully in terms of you don't want to be doing work that has not been required of you. Sometimes they only ask you to calculate the relevant chargeable gains and losses. Sometimes, as here, they ask you to calculate the capital gains tax. So again, read that requirement very carefully. What did Daisy do during the tax year? Disposed of the following assets within the 15-16 year. 30th of September 15, yep, that's in the 15-16 tax year, sold a business that she ran as a sole trader since February 09. Therefore, she certainly run this business and presumably therefore owned those assets for at least 12 months. The sale resulted in the following gains and losses. There's your standard business assets, properties used in the trade, like a factory or a warehouse, as here, and of course the intangible one, goodwill, the value of your goodwill. Well, you've got gains here computed on goodwill and factory, and a loss in relation to the warehouse. Clearly, in an exam question, you may have been required to have calculated those numbers. In relation to the factory and the warehouse, therefore, you'd be told not just the current value of that at which it was sold, but also the original cost figures, so you could work out gains or losses. In relation to goodwill, if here Daisy started that business, again we'd presume that that was the case, he started the business rather than buying an existing business, then there will be no cost, and you will simply take the market value of the goodwill at the time of disposal as being that gain. So we would be able to net out those gains and losses on the disposal of the business, and that net gain would then be eligible for entrepreneurs relief given the information that we are told. So 250 plus 320 there, we'll be talking about what, 570,000, take away the £90,000 loss, so that looks like £480,000 of loss on the disposal of a sole trader business that is available for relief. If, just to go back to a point raised in that first part of our discussions, if all Daisy was doing was to sell off the factory used within the trade, and that generated a gain of 320, but the trade continues on, then that gain would not be eligible for entrepreneurs relief. It must be a disposal of the business itself rather than simply an asset used within that continuing trade. But here, the business has been sold, sole trader disposed of the business, and the net gains arising of 480. What else did she do? In December 15, still in the 15-16 tax year, sold a 20% shareholding in Red Limited, an unquoted company. Now what it should also tell you here is, of course, that the company is a trading company. So if you can just note that in, yes, we'll assume here you will be told it's a trading company. If it was said to be an investment company, then no, there would be no possibility of entrepreneurs relief being available. It has to be a trading company. Daisy has been an employee of Bed Limited from the date she acquired the shares, and that was July 2010. Has she owned, therefore, the shares for at least 12 months? Yes, she has. What's the gain arising? Again, a figure given to you, 370,000, but you, of course, should know how to calculate any chargeable gain on the disposal of shares. So we've got a gain of 480, we've got a gain of 370, and looking at the information provided, both of those gains would be eligible for entrepreneurs relief. So we can basically do a single calculation here in relation to the gains chargeable. We got the gains on the business that has been sold off. That, as we've just seen, was net gains of £480,000. We've also got the gain on the share disposal on the shares, and that is £370,000. Now, each of those gains, as we've said, is eligible for entrepreneurs relief. So I can bring these two gains together and do a single CGT calculation on them all. As we will discover as we move on to the next part of this chapter, if we've got some gains that qualify for entrepreneurs relief and some that do not, then those gains must be kept separate. But here they all qualify, so we're looking at £850,000. Are there any other gains this year? Nope, can't see any. Are there any other losses either of the year or brought forward? No, there isn't. So all we get to do is to deduct our annual exempt amount, 11,100, in bringing us down, therefore, to our taxable gains. And those taxable gains, less 11,100 coming away from 850. So what's that going to be? That's going to be 838,900. I think 838,900. Right. We were told in the question here that what have we got? We've got those gains. Any information about whether any other gains had been made prior to this? Can't see any reference to that. We must therefore assume that that has not been the case. So on that basis, therefore, gains here of £850,000 were made. So on that basis, all those gains of 850,000 would indeed qualify for entrepreneurs relief. So on the taxable part of those gains, i.e. after deducting AEA, we have taxable gains of 838,900. That therefore will be taxed at 10%. Again, we'd state our reasons in a discursive question, in a section C question anyway, as to why entrepreneurs relief was available here. In relation to the business, it's a business owned for at least 12 months, run by the taxpayer here, and we're told what the gains are. You might, as we said, have to calculate that. And again, it's a trading business, so therefore it qualifies. The shares in the company, now you would need to have been told it was a trading company, but those gains, once computed, again qualify for entrepreneurs relief. All 850,000 qualifies. That's within your 10 million limit, assuming no other gains have been made here prior to this, and therefore it'll be taxed. The taxable gain will be taxed at 10%. Well, 10% therefore would be what? 83,890. 83,890 would be the due amount of tax. If they haven't asked for it, don't give it to them. But when would that tax be payable? The tax for the 15-16 tax year is due the following 31st of January, the 31st of January 17, therefore, will be the answer to that. Okay, have a little look through what we have done there. Make sure that we're happy with the principles so far as entrepreneurs relief are concerned before we continue on with our study of this relief. Well, in that first example, all of the gains arising qualified for entrepreneurs relief. We had the disposal of the business, the unincorporated trade, and also those qualifying shares in the trading company. What we therefore were able to do was to just deduct in total the AEA, our annual exempt amount, from that total gain. And had there been any losses available to offset against those gains, then those losses would have been set off again against the total. But what about if within the tax year we had a mix of gains, i.e. some that do qualify for ER on the disposal of qualifying business assets, and another gain or gains that do not qualify for ER because they're just disposals of investments. The issue then is, when it comes to deducting losses, when it comes to then deducting AEA, against which type of gain would you wish to be able to make those deductions? So let's think. The gains that qualify for ER will be taxed at just 10%, whereas those gains that do not qualify for ER will be taxed at 18%, or much more likely, as we'll see, 28%. So what would you rather reduce? Gains to be taxed at 10% or gains to be taxed at 28%? Very clearly, you would rather reduce those gains that would be taxed at the higher rate. And so it is therefore that here, good news in this second point in section 1.4, that our annual exempt amount and any capital losses that are available to us will be deducted firstly from gains that do not qualify for entrepreneurs relief against your investment rather than your business assets. Now that's very good news, because that will remove gains that would otherwise have been taxed at the higher CGT rates, 18 and, or as we've said, probably most likely here, 28%. There's then a little bit of bad news, and that's the first point. That although we get to deduct both losses and AEA from the gains qualifying for, against the gains that do not qualify for ER, against the investment assets, so those that would be taxed at the higher rate, when we then come to tax those other gains, the investment gains, what tax rate do we apply? Now, what we have here is that gains qualifying for ER must be taken into account when establishing which tax rate applies to the other capital gains in the tax year, in that they are deemed to firstly use any amount of unused basic rate band that the individual may have from his or her income tax computation. So for example, if on the taxpayer's income tax computation they had taxable income of £20,000, then that would still leave some £11,785 of the basic rate band available. Therefore, any taxable gains, we think, would firstly be taxed at 18% and then 28%. But what this note is telling you here is that if the gains that qualify for entrepreneurs relief were to exceed that amount of remaining basic rate band, here 11,785, so taxable income 20,000 I'm suggesting, available basic rate band 31,785 if I've correctly remembered the figure this time. On that basis, therefore, there's £11,785 worth of basic rate band remaining. But if the gains that qualify for ER exceed 11,785, even though those gains will not be taxed at 18, will not be taxed at 28, they will instead be taxed at 10%. They are deemed here to firstly use any amount of unused basic rate band, and therefore pushes those other gains on those investment assets out of the basic rate band up into the higher rate band, which is why I said you are likely to see here that it will certainly be 28% as being the rate to apply to those other gains. But at least good news, inasmuch as those other gains will have had the benefit of the deductions of both capital losses and the AEA. So when dealing with a problem where we've got this mix of gains that do and do not qualify for ER, we need to keep each category of gains separate. And that's what we'll see here now in example 2. So let's have a little read through what we're told, and what we've got to do is to calculate Anne's CGT for 2015-16 and stating the due date of payment. Well, there's the easy mark for the due date of payment. I hope we'll all recall there that that's the following 31st of January after the end of the tax year, so that'll be the 31st of January 17. But let's deal with the numbers and the calculation of Anne's CGT. We're told, firstly, that Anne sold her shareholding in Annie Limited for £5 million within our tax year. The shares had cost £500,000 back in July 91. Very simple gains calculation, therefore. 5 million minus 500,000 is a £4.5 million gain. She owned 100% of the shares in Annie Limited and had been a full-time director since the date of acquisition. Right. That means that she owns 100%, so she owns at least 5% of the shares. Remember, that was the minimum level required to be able to claim entrepreneurs relief on a share disposal. She owns 100%, so she does own at least 5%. And she's worked full-time in the company since the date of acquisition, which is significantly more than the last 12 months. So we are ticking the boxes in relation, therefore, to the availability of entrepreneurs relief on the disposal of those shares. We're also told that she's not made any disposals qualifying for ER in the past. Now, what that is about is that we know that there is a lifetime limit of £10 million. This is a very significant gain here, some £4.5 million. But all of that will now be available for ER. The £4.5 million gain will be available for ER. We're told that she also sold an antique painting, i.e. an investment asset, not a business asset, that upon it had a capital gain of £100,000. So the sale of the shares qualifies for ER, the sale of the painting does not. Anne has capital losses brought forward here of £25,000. That, of course, coming forward from 14-15. And her taxable income in 15-16 was £18,000. Now at £18,000, of course, taxable income, that's within the basic rate band, and of course would appear to leave some remaining basic rate band to be able to apply the 18% tax rate against that investment gain of 100,000. But that won't be possible, because we can see here that the ER gain at 4.5 million, although it will be taxed at 10% due to the availability of ER, all of this we have determined on a first read through. Even though that gain will not be taxed at either 18 or 28, it will only be taxed at 10%, it doesn't matter. For purposes of applying your 18 or 28% rate, the ER gain is deemed to be the first gain to be taxed, which more than uses up the remaining basic rate band from 18,000 up to 31,785, the limit of the basic rate band there. So the £100,000 worth of gains, or the part of it that will be taxed, remember, as we've said, it will get the benefit of the brought forward loss. It will get the benefit of the deduction of AEA. Those gains will be taxable at 28, whereas the £4.5 million in relation to the sale of shares, that will be taxed at 10%. So what we've got, therefore, is gains that qualify for ER, some ER gains, and we've also got our investment assets, non-ER gains. What were they? We had the gains on the disposal of the shares. Now again, you'd show a separate working for this, but that was 4.5 million. So £4,500,000. We had the disposal of the painting. That, of course, is a non-ER gain, and that, we're told, is a gain of £100,000 there. So 4.5 million and 100,000. Before we tax any of those gains, we get to deduct. Clearly, if there were losses of the year, they would be deducted first, and they'd go against the painting there. There were no such losses, but there were losses brought forward that amounted to £25,000, and they are deducted from those investment gains. That, of course, still leaves more than sufficient gain both here and on the ER to absorb the AEA, so there's no restriction of the use of the loss brought forward, and the AEA, again thankfully, is also available to go against the non-ER gains. So what do we get, therefore, in the way of taxable gains here? Well, our taxable gains, the 4.5 million, is untouched, whereas the non-ER gain on the painting, the investment there, that has been reduced by both the loss brought forward and the AEA. 25 plus 11.1 is what, 36,100 to deduct, so that will bring us down to 63,900. At what tax rates will they then be charged? The 4.5 million will be taxed at 10%. Again, if it's a written question, you can put a little note to say that the 4.5 is within the £10 million lifetime limit. So all of that gain enjoys the ER rate, the Entrepreneurs Relief Rate, and that'll be 10%. All of the 63,900 will be taxed at 28%. And again, you'd have a little note to explain why it is 28. Although we had taxable income of 18,000, less than the basic rate band limit, that gain that qualifies for ER is deemed to be the first gain that is taxed, and therefore is deemed to have used up any remaining basic rate band, pushing the non-ER gain very clearly into the higher rate bracket. That therefore means we're talking 28%. You should then be able to calculate your tax figures, your CGT liability, and put those in, as we said, with the accompanying notes there. So if you finish off that little exercise, work out the tax, I'd then like you to, again, as we have done on every other occasion, check out the answers to these examples in the course notes, again at the back of these notes. Now, once you've done that and hopefully agree with the answer, that sorts out the first of the available reliefs for the individual, Entrepreneurs Relief, which, as we said, is not really a relief other than, it's very good news, it's a lower tax rate, it's a 10% tax rate there. You must learn those disposals, those assets that qualify for ER, and be able then to calculate CGT for a taxpayer that has a mix of gains, such as Anne does here, with the mix of ER and non-ER gains that are chargeable for the year. What we'll do in our next session together is to move to the other reliefs. And the first couple of reliefs we're looking at were, which we mentioned earlier at the start of this session, will be rollover relief and gift relief. Now, both of those are the deferral reliefs that accept the position that the gain that has arisen there should be allowed to be deferred, not exempted, if the taxpayer so chooses to have it deferred. Once we've dealt with those reliefs, which will take up at least one more lecture, maybe two, then we'll come to the final relief within this section, at least within our syllabus anyway as well, and that is principal private residence, or PPR relief as we know it, that will actually serve to exempt some, if not all, of the gain arising when a taxpayer disposes of their so-called principal private residence, i.e. basically your home, the house in which you live. So, more of our reliefs in our next session together.